Most people fear the unknown. Most people say, oh, let's see, pandemic. That's a scary word, and I think that these things cause a lot of fear.
You write in your latest memo that nobody knows how bad the viral outbreak will be or how deep its economic impact will be.
Right.
And of course that's true. Nobody, not even Dr. Fauci, knows how bad this is going to be. But investors need a framework. Is deciding what to do as simple as saying buy if you're a coronavirus minimalist, or sell if you're a coronavirus maximalist?
Well, that would be a trading mentality. That's guessing what's going to happen next week or next month. And, I'm not. I'm an investor. And what an investor would do is say, how does the current price of a given asset compare with what I think is its long-term value? And, the point is that stocks are down about 12% from their high. Is that enough of a decline or too much of a decline or just about right? I think that it's a big decline. I think that the economy and the markets will have bad showings for a while, and then I think we'll come back.
So you say in the memo, and it's more or less what you just described, that one needs to evaluate the price change against the degree to which the fundamentals have worsened.
Right.
That's impossible right now.
It is impossible.
So why not evaluate the price change against the degree of uncertainty? Because that's where we were the last time you wrote a memo called Nobody Knows, right? We were on the brink of the economic collapse that followed the bankruptcy of Lehman Brothers.
Yes.
Now, if you went liquid right after Lehman Brothers went bankrupt, and then you waited to buy, you did relatively well. It was a whole lot easier to sell in September than it was to sell in November or December. Why not do the same thing now?
Well, I'm not sure I follow that. I don't think it was easier to sell. Everybody wanted to sell. The competition was on the selling side. The easy part was buying. And
well, things got worse. Things went further down.
Okay.
Yes.
Well, I don't think in terms of days and weeks. So you have me at a disadvantage. But, I mean, directionally, the question is, are things cheap or rich? Now, as you say, it's impossible to say. But on the other hand, I've been coming on your show for a couple of years saying that I thought things were steep. There was a lot of risk-taking going on. Things were priced for perfection.
Oaktree was exercising caution.
There was optimism. We were being cautious. And it was hard to buy things for less than they're worth. It was hard to get a bargain. That was the recurring theme. Now, we can't really be too doctrinaire about whether things are cheap or rich, but we know they're a heck of a lot cheaper than they were 2 weeks ago. And we know that there is panic. And by the way, when I say 12%, that's the overall. We know that there are great exceptions. And one of the things is that in times of chaos, investors fail to make fine distinctions. So things go down more than they should and less than they should. We have an opportunity, we think, to find the things that have gone down more than they should. It's a better climate for getting bargains today than it was 2 months ago.
Some people want to wait for the bottom.
Well,
is it better to buy now if you see a bargain than to wait for the bottom?
Well, I could ask you, what is the bottom, Eric? And
I have no idea.
Well, no, it's easy. The bottom is the day before it starts going up. But how do you know?
Right.
That's why I asked. The bottom is only judged in retrospect. So I think that, the book that you meant to plug, Mastering the Market Cycle, has a lot about this idea of waiting for the bottom. You never know when you're at the bottom, but you might have a feeling that something's cheap. And if it's cheap, you should buy it. If it goes down more, i.e. that wasn't the bottom, if it goes down more, buy some more. And keep your nerve and continue down as long as your assessment is right.
Howard, people want to know, is Oaktree out there right now catching falling knives?
Well, we're certainly buying. Yes, we're certainly buying. I mean, if you're a distress investor, you must turn more aggressive when you're given good chances. I'm not saying this is the bottom, but this is certainly a time to do some buying.
Some things are trading at distress levels.
Yes.
The market certainly isn't, or even close to
Overall
it.
stock market is
Sure.
not.
Well,
right.
or the credit market for
Right.
that matter.
Right.
Do you have a sense as to whether this will become the distressed credit opportunity that Oaktree and others have been waiting for these painful years of relentlessly rising stock markets?
Well, I would guess that it will. Now, what I can't tell you is the magnitude. Is it a replay of '08? Can't tell you. Or of 2000? Can't tell you. The real question is, how long will it last? You know, it's among the things that we don't know, as you enumerated, is whether it's going to last 2 months and the virus is going to disappear when the warm weather comes, or 18 months, which is when the outside date when Mr. Fauci says we'll have a vaccine. Well, that's a lot of spread. If it goes 18 months, we're going to have a serious event here, economically speaking.
This outbreak is what economists call an exogenous shock.
Yes.
It is not, or the economic impact isn't produced by faulty central bank policy,
Right.
for example, pulling the punch bowl away. It's also not the product of financial overexuberance,
Right.
like...
Or of company behavior.
Correct.
Right.
Is that important? Is that an important distinction?
Probably not. I mean, if you're a value investor and what you care about is the relationship of price and value, you don't care why you got there. Exogenous events can have a great impact. This one is, I think, particularly terrifying to most people. It's an unknown. Most people fear the unknown. Most people say, let's see, pandemic. That's a scary word, and I think that these things cause a lot of fear.